If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Chapter 1: The Case for Index Investing. Part 1: The Folly of Market-Beating Wall Street. Professionals spend millions on research, hire teams of analysts, and use sophisticated computer models to beat the market. Yet 85% of them fail over any 15-year period. The numbers tell a sobering story. Morningstar data reveals that between 2001 and 2020, only 23% of actively managed mutual funds beat their benchmark index over the full period. This means roughly 8 out of 10 professional money managers, despite their credentials and resources, delivered worse returns than simply buying and holding the entire market. Consider the case of Bill Miller, once hailed as a stock-picking genius. His Legg Mason Value Trust Fund beat the S&P 500 for an unprecedented 15 consecutive years, from 1991 to 2005. Financial magazines featured him on covers. Investors poured billions into his fund. Then, reality struck. From 2006 to 2011, his fund significantly underperformed, wiping out years of excess returns. Miller's story illustrates a fundamental truth. Even the most successful active managers eventually regress to average performance. The belief in beating the market stems from a basic misunderstanding of how markets work. When you buy a stock, someone else sells it. You both have access to the same information, yet one of you will be right and one wrong. Over thousands of transactions daily, these trades create the market price. If professional investors collectively are the market, how can they consistently beat it? Market timing presents an even greater challenge. A Dalbar study found that the average equity investor earned just 3.1% annually over 30 years, while the S&P 500 returned 10.5%. Why? Investors typically buy after good performance and sell after poor performance. They chase yesterday's winners and flee yesterday's losers. Peter Lynch, the legendary Fidelity manager, achieved remarkable returns during his tenure, but openly admitted that most investors in his funds lost money. How? They bought high after periods of strong performance and sold low during market downturns. Lynch himself recommended that most people simply buy index funds. The mathematics work against active management. In a zero-sum game, if some investors outperform, others must underperform by an equal amount. Add in trading costs, management fees, and taxes, and the average actively managed dollar must underperform the market. This isn't opinion, it's arithmetic. Human psychology compounds these challenges. Overconfidence leads investors to trade frequently, mistaking activity for progress. Studies show that the more people trade, the worse their returns become. The most active traders underperform by nearly 7% annually compared to buy-and-hold investors. Even institutional investors struggle. CalPERS. The massive California pension fund abandoned its active management strategies in 2014 after years of underperformance cost retirees billions. Their conclusion? Simple index investing would have delivered better results for their members. Part 2: Historical Performance and Evidence. The numbers tell a story that Wall Street prefers you ignore. Over the past 50 years, the S&P 500 index has delivered average annual returns of approximately 10%, while the typical actively managed equity fund has returned just 8.5% after fees. That 1.5% difference might seem small, but compounded over decades, it represents hundreds of thousands of dollars lost to the average investor. Consider the period from 1970 to 2020. A $10,000 investment in an S&P 500 index fund would have grown to roughly $697,000. The same amount in the average actively managed fund would have reached only $497,000. The $200,000 difference went straight into the pockets of fund managers and brokers. This pattern holds true across virtually every time period researchers have examined. The evidence becomes even more compelling when you examine longer time frames. Morningstar's 2021 study tracked actively managed funds over 20-year periods and found that fewer than 25% consistently outperformed their benchmark indices. More telling, of the funds that did beat the market in one decade, only a tiny fraction repeated that performance in the following decade. Vanguard's founder witnessed this phenomenon firsthand when studying mutual fund performance in the 1960s. Fund managers who were celebrated as geniuses one year often became yesterday's news, when their hot streaks inevitably cooled. The Wellington Fund, where he worked early in his career, exemplified this pattern: periods of outperformance followed by disappointing returns that wiped out any advantage. The math works against active management in another crucial way. Every time a fund manager buys or sells a stock, transaction costs eat into returns. The average actively managed fund turns over its entire portfolio annually, generating trading costs that rarely appear in advertised expense ratios. Index funds, by contrast, trade only when companies enter or leave their target index, perhaps 2 to 5% portfolio turnover per year. Historical data also reveals the futility of market timing. The worst single day in stock market history was often followed by some of the best days. Missing just the 10 best trading days over a 30-year period would cut your total returns by more than half. Yet many active managers, convinced they can predict short-term movements, regularly move in and out of positions. Even during market downturns, index funds demonstrate their superiority. During the 2008 financial crisis, when many actively managed funds panicked and sold at the bottom, index funds simply held their positions and recovered alongside the broader market. Part 3. The Power of Simplicity. Think simple investing beats complicated strategies? Wall Street wants you to believe otherwise, but the numbers tell a different story. Consider Warren Buffett's famous bet with hedge fund manager Ted Seides in 2007. Buffett wagered that a simple S&P 500 index fund would outperform a collection of hedge funds over 10 years. The result? The index fund delivered 7.1% annual returns, while the hedge funds managed only 2.2%. This wasn't luck. It was the power of keeping things simple. Most investors believe complexity equals sophistication. They chase funds with elaborate strategies, multiple asset classes, and star managers who promise to beat the market. But this approach often backfires. The more moving parts a fund has, the more opportunities for mistakes. Active managers must make countless decisions daily: which stocks to buy, when to sell, how to time the market. Each decision carries risk. Index funds follow a radically different philosophy. They buy everything in a market index and hold it. No stock picking, no market timing, no costly research teams analyzing quarterly earnings. When Apple stock rises, it rises in the fund. When it falls, it falls. The fund simply mirrors the market's performance. This simplicity creates several advantages. Transaction costs plummet because index funds rarely trade. A typical actively managed fund might turn over 80% of its holdings annually, generating trading fees and tax consequences. Index funds typically turn over less than 5% yearly. These savings compound dramatically over decades. The psychological benefits matter equally. Simple strategies prevent emotional decision-making. When markets crash, active fund managers often panic and sell at exactly the wrong time. Index fund investors, following a predetermined strategy, avoid these costly emotional reactions. Vanguard's Total Stock Market Index Fund exemplifies this approach. Since its inception in 1992, it has consistently delivered market returns minus tiny fees, currently just 0.03% annually. Meanwhile, the average actively managed large-cap fund charges 0.67% and has underperformed this simple index fund by roughly 1% annually after fees. The beauty of index investing lies not in its complexity, but in its elegant simplicity. By accepting market returns instead of chasing mythical outperformance, investors actually achieve superior long-term results. Sometimes the smartest strategy is also the simplest one. Part 4. Costs. The silent killer. Investment fees seem insignificant when expressed as percentages, but they accumulate into wealth-destroying forces that most investors never fully grasp until retirement. Consider two investors starting with identical $100,000 portfolios over 30 years. The first pays a typical 1.5% annual fee for active management, while the second chooses a low-cost index fund charging 0.1%. Assuming identical 7% gross returns, the first investor ends with $432,194, while the second accumulates $659,634. That seemingly modest 1.4% difference costs the first investor $227,440 in lost wealth. John Bogle understood this mathematical reality better than anyone. He recognized that investment costs work like compound interest in reverse, stealing returns year after year. While compound growth builds wealth exponentially, compound costs destroy it with equal power. The financial services industry rarely highlights this uncomfortable truth. Management fees represent just the tip of the iceberg. Trading costs, sales loads, redemption fees, and tax consequences from frequent portfolio turnover create additional drags on performance. Morningstar data shows the average actively managed equity fund charges approximately 1.0% in annual expenses, while broad market index funds average just 0.05%. This 0.95% difference compounds relentlessly over decades. Real-world examples prove costs matter more than most investors realize. Fidelity's Contra Fund, managed by star portfolio manager Will Danoff, generated impressive gross returns over many years. However, after deducting the fund's 0.85% expense ratio and considering taxes from distributions, investors received significantly less than the headline performance numbers suggested. Meanwhile, Vanguard's S&P 500 Index Fund, with its minuscule 0.03% fee, delivered nearly identical net returns to investors with far less complexity. The psychology of cost perception works against investors. A 1% fee feels negligible compared to volatile daily price swings of 2% or 3%. Yet those dramatic daily movements eventually average out to market returns, while the 1% fee compounds relentlessly downward every single year without exception. Tax efficiency adds another layer to the cost equation. Index funds rarely sell holdings, generating minimal taxable distributions. Actively managed funds, constantly buying and selling stocks, frequently trigger capital gains taxes that further erode investor returns. Vanguard estimates this tax drag costs actively managed fund investors an additional 1.0 to 1.5% annually in taxable accounts. The solution seems almost too simple to believe. Choose the lowest cost option available, minimize trading, and let time work in your favor. Warren Buffett's famous bet with hedge fund manager Ted Seides proved this principle. Over 10 years, a simple S&P 500 index fund outperformed a collection of hedge funds, despite the latter's supposed expertise and active management. Costs truly are the silent killer of investment returns. They work tirelessly against investors, never taking a day off, never reducing their impact. Recognizing this reality represents the first step toward building lasting wealth through sensible, low-cost investing strategies. Chapter 2. How Markets Really Work. Part 1. The Zero-Sum Game. Think of the stock market like a giant poker game where every dollar won must come from someone else's pocket. Most people believe the stock market creates wealth for everyone who participates. This sounds logical since companies grow and economies expand. But here's what actually happens when you look at the mechanics of trading itself. Every single transaction involves one person buying and another person selling. When Apple stock rises from $100 to $110, The person who sold at $100 loses that $10 gain, while the buyer captures it. Vanguard's founder, Jack Bogle, called this the zero-sum game before costs. Imagine a room with 1,000 investors trading stocks back and forth. At the end of the year, their collective gains exactly equal their collective losses. The math is ironclad. For every winner, there must be a loser of equal magnitude. But costs change everything. Those same 1,000 investors pay fees to brokers, fund managers, and advisors. They trigger taxes through frequent trading. These expenses don't disappear into thin air. They reduce the total returns available to investors. Now, instead of a zero-sum game, it becomes negative-sum. The average investor must underperform the market by the amount of all costs combined. Consider what happened to Janus 20 Fund during the tech boom. Star manager Bill Miller beat the market for years, attracting billions in investor money. But after accounting for the fund's 1.2% annual fee, transaction costs, and the poor timing of investors jumping in at peaks, most shareholders actually lost money while Miller collected management fees. The numbers tell this story clearly. Morningstar data shows that over 15 years ending in 2020, roughly 85% of actively managed funds failed to beat their benchmark indexes. The few winners rarely repeat their success consistently. Wall Street profits regardless of your investment outcomes. Brokers earn commissions on trades. Fund companies collect fees based on assets under management, not performance. Investment banks generate revenue from IPOs and trading volume. They win whether you win or lose. This creates a peculiar situation. The financial industry employs thousands of brilliant people with advanced degrees, sophisticated computer models, and insider access to company management. Yet collectively, they cannot beat a simple index fund that just buys everything and holds it. Why? Because they're competing against each other in that same zero-sum game, while charging high fees that guarantee most participants will lose. The solution becomes obvious once you understand the game's structure. Instead of trying to pick winners, own everything through low-cost index funds and capture whatever returns the market provides. Part 2. Winners, losers, and costs. Most people think making money in the stock market is about finding the smartest fund manager. But Vanguard founder Jack Bogle proved otherwise with startling mathematical precision. Here's the harsh reality about active fund management that Wall Street doesn't advertise. When Morningstar analyzed performance data from 2000 to 2020, they found something remarkable. Out of roughly 3,000 actively managed U.S. stock funds, only about 300 consistently beat their benchmark index over that 20-year period. That's just 10%. The other 90% failed to justify their higher fees. But the story gets worse when you examine the costs. The average actively managed fund charges about 1.2% annually in fees, while a basic index fund costs around 0.05%. This difference might seem small, but consider what happened to investors in American Funds Growth Fund of America versus the S&P 500 index from 1990 to 2020. Despite having talented managers and billions in resources, the fund returned 9.8% annually while the index delivered 10.7%. That 0.9% gap, compounded over 30 years, meant investors gave up hundreds of thousands of dollars in potential returns. The mathematics create an impossible situation for most active managers. Think about it this way. If you're playing poker at a table where the house takes a cut of every pot, you need to be significantly better than average just to break even. Fund managers face the same challenge. They must overcome their fees, trading costs, and tax inefficiencies while competing against other professionals with similar information and tools. Peter Lynch, the legendary manager of Fidelity Magellan Fund, understood this reality. During his famous run from 1977 to 1990, he beat the market by 2.7% annually. but Lynch himself admitted that most investors in his fund didn't capture those returns because they bought high and sold low, chasing performance after it had already happened. The few managers who do consistently win often close their funds to new investors once they get too large. Warren Buffett stopped accepting outside money in his partnership because he knew size would hurt performance. This leaves ordinary investors with the remaining managers who are either unproven or managing assets too large to be nimble. The cruel irony is that the more investors chase these winning managers, the more they guarantee their own underperformance. High fees compound against you every single year, whether the market goes up or down. Part 3. Speculation versus investment. Most people think the stock market is just one giant money-making machine. Here's the uncomfortable truth. It's actually a giant casino where the house always wins. The distinction between speculation and true investment is like the difference between betting on roulette and owning the casino. Speculators try to predict whether Microsoft will beat earnings next quarter or if tech stocks will soar this month. They're essentially gambling. Real investors buy a slice of American business and hold it for decades. Consider what happened during the dot-com boom of the late 1990s. Day traders quit their jobs to flip internet stocks hourly. They called themselves investors, but they were speculators betting on momentum. When the music stopped in 2000, most lost everything. Meanwhile, patient investors who simply held broad market index funds through the crash recovered and thrived over the following decades. The math behind speculation is brutal. Every time you buy and sell, you pay trading costs. You pay taxes on short-term gains at ordinary income rates, which can exceed 35%. You make emotional decisions when money is on the line. Academic research from Brad Barber and Terence O'Dean studied 66,000 households and found that the most active traders earned 7% less per year than buy-and-hold investors. True investment is remarkably boring by comparison. You buy index funds that own every major company in America. You reinvest dividends automatically. You add money regularly, regardless of headlines. You never sell. This approach captured nearly all of the stock market's 10% annual return over the past century. The speculation industry wants you to believe you can beat this simple approach. They sell complex strategies, market timing systems, and hot stock picks. They profit whether you win or lose because they collect fees for every trade. It's like playing poker against professionals who take a cut of every pot. John Maynard Keynes, who started as a speculator, eventually learned this lesson the hard way. After losing heavily trying to time markets, he switched to long-term investing and rebuilt his wealth. His famous quote captures the essence: "The market can remain irrational longer than you can remain solvent." The choice is simple. You can spend your time trying to outsmart millions of other investors, or you can join them by owning everything they're fighting over. Part 4. The permanent advantage of index funds. The most elegant solutions are often the simplest ones, and index funds represent investing's ultimate example of elegant simplicity. When Jack Bogle launched the first index fund in 1976, Wall Street mocked it as Bogle's Folly. The fund industry couldn't understand why anyone would want average returns when they promised to beat the market. Fast forward to today, and that folly has grown into trillions of dollars, consistently outperforming most active funds over decades. The secret lies in mathematics that never changes. Index funds don't try to beat the market because they are the market. While active managers scramble to find the next winning stock, index funds simply buy everything. This approach guarantees you'll capture whatever returns the market delivers. Consider the numbers from Vanguard's S&P 500 Index Fund. Since 1976, it has charged an expense ratio of just 0.04% annually. Compare this to the average actively managed fund that charges around 1% per year. That difference might seem small, but compounded over decades, it becomes enormous. A $10,000 investment growing at 8% annually would be worth $466,000 after 40 years with the index fund's low costs. But only $320,000 with the higher active management fees. The math gets even more compelling when you factor in taxes. Index funds rarely sell stocks, so they generate minimal taxable events. Active funds, constantly buying and selling in search of the next big winner, create tax bills that further erode returns. Dimensional fund advisors found that taxes can reduce active fund returns by an additional 1 to 2% annually for taxable investors. Warren Buffett proved this point with his famous 10-year bet. In 2008, he wagered that a simple S&P 500 index fund would outperform a collection of hedge funds chosen by investment professionals. The result wasn't even close. The index fund returned 7.1% annually, while the hedge funds managed just 2.2%. The beauty of index funds extends beyond costs. They provide instant diversification across hundreds or thousands of companies. When Enron collapsed in 2001, it represented less than 0.5% of the S&P 500. Index fund investors barely noticed. Active fund managers who concentrated their bets on sure things saw devastating losses. This advantage compounds year after year. While active managers struggle against the twin headwinds of high fees and the impossible task of consistently picking winners, index funds simply march forward with the market's progress. Chapter 3: Building Wealth the Common Sense Way, Part 1: Principles of Long-Term Investing. Think about this. Your neighbor Joe started investing in 1982 with just $10,000. Today, that money is worth nearly $600,000, despite surviving Black Monday, the dot-com crash, and the 2008 financial crisis. The secret? He never touched it. This is the raw power of compounding returns, and it forms the bedrock of successful long-term investing. Albert Einstein reportedly called compound interest the eighth wonder of the world, and he was right. When your investment gains earn their own gains, year after year, the results become extraordinary. A 10% annual return doesn't just double your money in 10 years, it nearly triples it. But here's where most investors stumble. They treat the stock market like a casino instead of a wealth-building machine. Consider the data from Dalbar, which tracks actual investor returns versus market performance. While the S&P 500 averaged 10.5% annually from 1995 to 2014, the average equity investor earned only 5.2%. Why the massive gap? Poor timing decisions driven by fear and greed. Warren Buffett's teacher, Benjamin Graham, once said, "The market is a voting machine in the short run, but a weighing machine in the long run." This means daily price movements reflect emotion, while long-term trends reflect actual business value. When Amazon stock dropped 95% during the dot-com crash, panicked investors sold. Patient ones who held or bought more became millionaires as the company's true value emerged. The arithmetic of successful investing is surprisingly simple. Consistency matters more than perfection. Dollar cost averaging, investing the same amount regularly regardless of market conditions, naturally buys more shares when prices are low and fewer when prices are high. This mechanical approach removes emotion from the equation. Time becomes your greatest ally through what professionals call time arbitrage. Young investors have decades for their investments to compound, which means they can weather any storm. Even those starting later benefit enormously. A 45-year-old who invests $500 monthly until retirement will accumulate more than someone who invests $300 monthly starting at age 25, assuming average market returns. The key insight? Markets reward patience, not intelligence. Academic research consistently shows that professional money managers, despite their expertise and resources, struggle to beat simple index funds over extended periods. The explanation is mathematical. High fees and frequent trading create drag on returns that compounds negatively over time. Your investment success depends less on picking winners and more on avoiding losers, particularly the losing behavior of buying high during market euphoria and selling low during crashes. The investors who build real wealth understand that boring beats brilliant, and time in the market trumps timing the market every single time. Part 2. The role of asset allocation. The smartest investors win not by what they buy, but by how they divide their money. Think of asset allocation like building a sturdy house. You need different materials for different parts. Wood alone might work for framing, but you need concrete for the foundation and steel for critical supports. Your investment portfolio works the same way. Stocks provide growth potential, bonds offer stability, and cash gives you flexibility. The magic happens when you combine them thoughtfully. John Bogle discovered this principle while studying retirement plans in the 1980s. He noticed that investors who split their money between stocks and bonds consistently outperformed those who put everything in one basket. The reason was simple. Different assets move in different directions at different times. When stocks crashed in 2008, bonds often rose. When inflation hit in the 1970s, stocks eventually recovered while bonds struggled. Your age and situation determine your mix. A 25-year-old starting her career might put 90% in stock index funds and 10% in bonds. She has decades to ride out market storms. A 65-year-old planning retirement might choose 60% stocks and 40% bonds. He needs more stability since he will start using this money soon. The Yale Endowment Fund demonstrates this power. Under David Swensen, Yale spread investments across stocks, bonds, real estate, and commodities. This diversification helped the fund grow from $1 billion to over $30 billion between 1985 and 2019. But here is the key. They used mostly index funds within each category. Many investors make asset allocation too complicated. They chase exotic investments or constantly adjust their mix based on market predictions. Bogle advocated simplicity. Pick your allocation based on your age and goals, then stick with it. Rebalance once a year by selling what grew too much and buying what fell behind. Consider Sarah, a teacher who started investing in 2000 with 70% stocks and 30% bonds. During the tech crash, her stocks fell, but her bonds held steady. She rebalanced by selling bonds to buy more stock index funds when they were cheap. By 2020, this simple approach had grown her modest salary contributions into a seven-figure retirement account. The beauty of proper asset allocation is that it forces you to buy low and sell high automatically. When stocks soar, rebalancing makes you take profits. When stocks crash, rebalancing makes you buy more. This systematic approach removes emotion from investing and captures the mathematical advantage that compound growth provides over time. Part 3. Avoiding emotional pitfalls. Even the most rational people turn into emotional wrecks when money is involved. Your brain becomes your worst enemy the moment you open your investment account. The same person who carefully researches a $50 purchase will panic and sell thousands of dollars worth of investments because the news mentioned a market drop. This happens because our brains are wired for survival in a world that no longer exists. Consider what happened to millions of investors during March 2020. When the pandemic hit, the S&P 500 dropped 34% in just over a month. The average investor sold their holdings near the bottom, locking in massive losses. Those same stocks recovered within 6 months and reached new highs by year's end. The investors who sold missed the entire recovery. This pattern repeats every market cycle. During the 2008 financial crisis, investors pulled $230 billion out of stock funds while the market was crashing. They then waited years before getting back in, missing most of the recovery. The same people who bought houses at peak prices in 2006 were now selling stocks at rock-bottom prices in 2009. Your emotions follow a predictable cycle. When markets rise, you feel invincible and want to buy more. When they fall, you feel terrified and want to sell everything. This cycle of greed and fear guarantees you will buy high and sell low. The financial media makes this worse by treating every market move like breaking news. The solution is building systems that bypass your emotions entirely. Warren Buffett's teacher, Benjamin Graham, once said the investor's chief problem is likely to be himself. Graham was right. Studies show the average investor earns about 2% less per year than the funds they own simply because they buy and sell at the wrong times. Successful investors develop what psychologists call emotional regulation. They create rules before panic sets in. When Vanguard studied their most successful investors, they found a surprising pattern. The best performers were either dead or had forgotten they owned investments. These investors couldn't panic sell because they weren't actively managing their accounts. The key is removing yourself from daily market movements. Stop checking your balance every day. Set up automatic investments that continue regardless of headlines. Treat market drops like sales at your favorite store. Most importantly, remember that temporary volatility is the price you pay for long-term wealth creation. Part 4. Staying the course. The hardest part about investing isn't picking the right funds or timing the market perfectly. It's doing absolutely nothing when everyone around you is panicking or celebrating. Warren Buffett calls this the most difficult skill in investing, and he's right. Think of staying the course like being a lighthouse keeper. While storms rage and waves crash, the lighthouse stands firm. It doesn't move with every gust of wind or change direction based on weather patterns. Your investment strategy should work the same way. When the 2008 financial crisis hit, investors who maintained their regular contributions and avoided selling captured the entire recovery that followed. Those who fled to cash missed gains that took years to materialize again. Market noise is everywhere. Financial news channels need content 24 hours a day, so they turn minor market movements into breaking news. Social media amplifies every rumor and prediction. Your neighbor might brag about his latest stock pick or warn you about an impending crash. This constant chatter creates an illusion that you must act, that doing nothing means missing opportunities or courting disaster. Consider what happened during the dot-com bubble. Investors who stuck with their boring index funds while everyone else chased internet stocks looked foolish for years. Then the bubble burst. Suddenly, those steady investors who kept making regular contributions looked brilliant. They had been buying more shares when prices were low during the crash. Frequent trading is the enemy of wealth building. Every time you buy and sell, you pay fees and taxes. More importantly, you're trying to time decisions that professional fund managers with teams of analysts struggle to make consistently. The average investor who trades frequently earns about 3% less per year than the market itself, largely due to poor timing decisions. Steady contributions work like a financial autopilot system. When markets are high, your regular investment buys fewer shares. When markets drop, the same amount buys more shares. This dollar-cost averaging happens automatically without requiring you to make emotional decisions during stressful periods. The most successful investors often joke that the best strategy is to buy index funds and then lose the password to your account. While that's extreme, the principle holds true. The less you interfere with your investments, the better they tend to perform. Set up automatic contributions, ignore daily market movements, and let compound interest do the heavy lifting over decades. Chapter 4. The Real-Life Impact of Bogle's Approach. Part 1. Individual Investor Stories. But what happens when ordinary people actually follow this simple advice for decades? Take Ronald Read, a Vermont gas station attendant and janitor who died in 2014 with an $8 million portfolio. Read never earned more than minimum wage, yet he consistently invested in blue-chip stocks and held them for decades. His strategy mirrors the index fund approach, buying broadly diversified holdings and never selling. Reed's story went viral because it challenged everything Wall Street tells us about needing expensive advisors and complex strategies. The numbers tell similar stories across America. A 2019 Dalbar study found that the average equity fund investor earned just 5.04% annually over the past 20 years, while the S&P 500 returned 7.20%. Yet thousands of ordinary investors quietly outperformed by simply buying index funds and doing nothing. They understood what Warren Buffett proved when he made $1 million bet that an S&P 500 index fund would beat hedge funds over 10 years. The index fund won by a landslide. Consider Ann Scheiber, an IRS auditor who invested $5,000 in 1944 and left $22 million to charity in 1995. She bought dividend-paying stocks and reinvested everything for 51 years. Her approach required no genius, just persistence and low costs. Modern investors achieve similar results with even less effort through index funds. The most compelling stories often come from teachers and government workers who max out their 403(b) plans with index funds. A California teacher named Susan invested $500 monthly in the Vanguard 500 index fund starting in 1985. By retirement in 2020, her simple strategy had grown to over $2 million. She never read financial magazines, attended seminars, or hired advisors. She just kept buying and held on. These stories matter because they prove the mathematics work in real life. Compound interest multiplies money predictably when costs stay low and emotions stay controlled. A study of 401(k) participants found that those who made the fewest changes to their portfolios earned the highest returns. The most successful investors were often people who forgot they even had accounts. Grace Groner, a secretary at Abbott Laboratories, bought $180 worth of company stock in 1935 and reinvested dividends for 75 years. She died worth $7 million. Her approach, buy quality companies, reinvest everything, and wait decades, is exactly what index funds automate for modern investors. The common thread among these success stories isn't intelligence or market timing. It's discipline, low costs, and time. These investors ignored the noise, avoided expensive products, and trusted in capitalism's long-term growth. Their results embarrass Wall Street precisely because they achieved wealth through simplicity rather than sophistication. Part 2. The Institutional Revolution. By 2010, a remarkable transformation had occurred in boardrooms across America. The pension fund trustees who once worshipped at the altar of active management were quietly moving billions into index funds. The shift started with the biggest players, the California Public Employees Retirement System, CalPERS, managing over $300 billion. Watch their expensive active managers consistently fall short of simple market returns. Year after year, they paid millions in fees to fund managers who promised to beat the market but delivered disappointment instead. The pension fund's board asked a simple question: why pay premium prices for inferior results? Yale University's endowment provided another wake-up call. David Swensen, their chief investment officer, built his legendary reputation partly by advocating low-cost investing principles that mirror index fund philosophy. While Swensen used different vehicles than traditional index funds, his core message resonated. Costs matter enormously, and most active management destroys wealth rather than creating it. The mathematics became impossible to ignore. When a pension fund pays 2% annually in management fees, plus performance bonuses, those costs compound devastatingly over decades. A $100 million pension fund losing just 1% annually to excess fees means retirees receive $22 million less after 25 years. Board members responsible for worker retirements couldn't justify such massive wealth transfers to Wall Street. Corporate 401(k) plans followed suit. Companies like IBM and Vanguard itself began defaulting employee contributions into index funds rather than expensive, actively managed options. The results spoke volumes. Employees in these plans accumulated wealth faster, despite or because of the simplicity of their investments. Even traditional mutual fund companies surrendered to reality. Fidelity launched their own index funds, despite built their empire on stock-picking prowess. BlackRock became the world's largest asset manager by focusing heavily on index products. These companies recognized that fighting the tide of institutional demand for low-cost investing meant losing business to competitors who offered what clients actually wanted. The institutional revolution validated Bogle's central thesis on a massive scale. When the smartest money managers in the world, trustees responsible for trillions in pension assets, choose simplicity over sophistication, it proves that common-sense investing works regardless of account size. The shift from active to passive management in institutional investing represents perhaps the most dramatic validation of any financial theory in modern history. Part 3. Challenging Wall Street Norms. Wall Street makes money when you trade, not when you hold. This fundamental truth explains why the financial industry fights against the very simplicity that benefits investors. Consider how brokerages profit from complexity. Charles Schwab's internal documents from the 1990s revealed that their most profitable clients were frequent traders, not buy-and-hold investors. Each trade generated commissions. But more importantly, active clients required expensive research departments, analyst coverage, and constant market commentary. The entire ecosystem thrived on movement, not patience. Traditional mutual fund companies like Putnam and Lord Abbett built business models around asset gathering and frequent portfolio turnover. Higher fees funded massive marketing budgets, celebrity fund managers, and elaborate research operations. When Bogle introduced the first index fund with a 0.15% expense ratio, he wasn't just offering a cheaper product, he was attacking the industry's profit structure. The resistance was fierce and personal. Fund industry executives publicly dismissed index investing as un-American and guaranteed mediocrity. Fidelity's Peter Lynch famously argued that settling for market returns meant giving up on the American dream of beating the market. These weren't intellectual debates about investment theory. They were business leaders protecting revenue streams. Wall Street's complexity serves a purpose beyond confusing investors. Take hedge funds, which averaged 2.2% management fees plus 20% of profits during the 2000s. These structures required sophisticated explanations, lengthy legal documents, and exclusive access to justify their costs. Simplicity threatened this mystique. The mutual fund scandal of 2003 exposed how traditional firms prioritized profits over investor interests. Companies like Strong Financial and Bank of America allowed market timing that harmed long-term shareholders while generating additional fees. Bogle's transparency model, publishing all costs, holding identical securities, and eliminating conflicts of interest, stood in stark contrast. Technology eventually supported his arguments. When discount brokerages eliminated trading commissions in 2019, they removed one barrier to frequent trading. However, studies showed that commission-free trading actually increased investor losses as people traded more often with worse timing. The shift toward fee transparency regulations forced the industry to disclose what Bogle had been saying for decades. High fees compound against investors just as powerfully as returns compound in their favor. A 2% annual fee on a $100,000 portfolio costs $63,000 over 20 years when accounting for lost compound growth. Wall Street adapted by creating new complexity. Target date funds, smart beta strategies, and factor-based investing emerged as middle grounds between active management and pure indexing. While some innovations added value, many simply repackaged basic concepts with higher fees, proving that the industry's instinct for complexity remains stronger than its commitment to investor welfare. Part 4. Investing as Stewardship. This shift from exploitation to empowerment reflects a fundamental truth about investing. When you buy an index fund, you become part owner of thousands of real companies employing millions of people. Warren Buffett understood this when he instructed his estate to place 90% of his wealth in index funds, not because it would beat the market, but because it represents genuine ownership in American enterprise. Consider what happens when you purchase shares in the S&P 500 index. You own pieces of Apple's innovation labs, Amazon's distribution networks, and Microsoft's cloud infrastructure. These aren't abstract financial instruments, but stakes in businesses creating jobs, developing technologies, and solving real problems. When Apple sells another iPhone or Amazon delivers another package, you participate in that economic activity as an owner, not a speculator. The distinction matters enormously. Speculation treats markets like casinos, where wealth transfers from losers to winners without creating value. Stewardship treats markets as mechanisms for channeling capital toward productive enterprises that generate wealth for society. John Templeton exemplified this approach, viewing his investment choices as votes for companies that would improve human welfare over decades. Index investing naturally promotes this stewardship mindset because it eliminates the gambling mentality that active trading encourages. When you cannot pick individual stocks or time market movements, you focus on what truly matters, the long-term growth of the economy itself. You stop asking which stocks will win tomorrow and start asking how businesses will create value over the next 20 years. This perspective transforms your relationship with market volatility. Instead of panicking during downturns, you recognize that temporary price fluctuations reflect the natural cycles of business expansion and contraction. The 2008 financial crisis, for instance, created buying opportunities for patient investors who understood that well-managed companies would eventually recover and grow stronger. The Norwegian government pension fund Global demonstrates institutional stewardship at massive scale. With over $1.3 trillion invested primarily in index funds, it owns approximately 1.5% of all publicly traded companies worldwide. Rather than trying to outsmart markets, Norway uses its oil wealth to participate in global economic growth while promoting responsible corporate governance. This approach creates a virtuous cycle. When more capital flows through low-cost index funds, companies face less pressure to meet quarterly earnings expectations and can focus on sustainable growth. Managers spend time building businesses rather than managing investor relations. Resources flow toward productive activities rather than financial engineering designed to manipulate stock prices. Your investment dollars become votes for this healthier version of capitalism, where success comes from creating value rather than extracting fees from other investors.